So we're here with Don again from Plato. Thanks again for joining us, Don. Don, can I start today by asking you, we've just been basically through the reporting season, the first reporting season for 2016. What for you were the highlights, lowlights? Is there anything we got out of this reporting season that will shape how we look for the rest of the year?
Well, to be honest, I don't think there are too many high or lowlights in that thing, but there are a couple of takeouts. The first one is, first month or two of this year, particularly January, everyone was extremely negative. The macro picture was negative. But when you look at the actual earnings numbers, they weren't too bad. There weren't too many spectacular results, but there weren't too many absolute blowouts. Yes, there were some bad results from the BHPs and some of those, but to be honest, and Fortescue is an example of that, it wasn't as bad as what people had thought, because the miners, particularly BHP, Rio and Fortescue, have been very aggressive at cutting costs. So the real surprise one I focus on is the amount of cost reduction that's come out of those guys. And even post-reporting season, BHP are now talking up the fact they can continue to grow. They can actually grow earnings even in a fairly soft environment by focusing even more so on cost cutting. Banks are a bit soft. That's certainly a feature of just the latest numbers. But again, put that in the backdrop of, I suppose, a couple of issues. One, they all raised a lot of capital last year. So if you look at their earnings per share, there's a lot more shares around, and the dividends per share, and most of the banks have maintained the same sort of dividend level except for ANZ. But I'd also say that at the moment the banks have got 3 new CEOs, and there's a tendency for those CEOs to make things as bad as they are in their first year. Make the profits look a bit soft so that, I might be a bit cynical here, but in a couple of years' time, they can say, look at the earnings growth you've had from that bad first year. And of course, if you write off your IT expenses or you write off assets in the first year, next year you're not going to have that write-off. So it almost means for sure that then profits in the next year or two are going to grow just because they've already taken the hard news.
So the lead into that season it was fairly negative in many respects, and the market was quite volatile leading in. There hasn't really been a massive sort of jump or recovery as a result of that, or the market certainly hasn't sort of taken off. What are your thoughts in terms of how the market's reacted to the actual information versus expectation, and what does that look like then for the rest of the year, do you think?
Well, the market hasn't taken off, but we're actually back above where we were, I think, at the start of the year. So we've got all that bad news that came out in the first month of the year when there were some very negative headlines about selling all assets and it's all, everything's going to pot. We have seen a bit of a turnaround in some of the fundamentals. So, at the moment, oil prices seem to be a bit of a litmus test for fundamentals, and they've bounced off nicely from probably an oversold position, and to some extent iron ore in the same sort of bracket. So those have been there. But the reality is now markets are generally up for the year. So it's not as bad as what people were, would just about cut their wrists a few months ago.
And probably the big shock then was the recent cut in interest rates by the RBA. Very few, you'd say, were generally sort of predicting that. In fact, it was probably more of a flat for a long time, and people sort of looking at when the raise might come, although no one was expecting that really very soon. Was that a surprise to you, and what implications do you think that has?
It was a surprise, definitely. 2 months ago, just about everyone was talking about interest rates are going to stay at 2% for the rest of the year, and there were 1 or 2 economists even forecasting potentially a rise at the end of the year. And then suddenly we have a low inflation number, and bang, we've cut our rates. Now, I wouldn't say it's total surprise when you go back and look at what else is happening in the world, because Japan had also lowered their interest rates only about 2 months ago to a negative level. So there's still a bit of a push globally to reduce interest rates. And in the US, the expectations about interest rate rises, which is about the only country in the world where there are expectations of interest rate rises, those expectations have actually come down a lot in terms of, yes, interest rates are still going up, but they're not going to go up. The expectations are they're going to go up a lot slower than we thought even 3 or 4 months ago. So there's still globally, rates are lower for longer. So when you look back in that context, maybe it's not as surprising that the RBA have come. I think that the surprising number was probably the fact the inflation number was as low, and that enabled them to move pretty quickly. But certainly it has changed expectations significantly in the last 4 weeks here in Australia.
And will that, do you think, have much implications in terms of the domestic market and domestic economy in the short term, or do you think it's more about getting us more even with the international.
Yeah, I don't think that quarter point cut is going to do a hell of a lot for the economy. It's probably done a little bit for the mood. It's probably helped a little bit the equity market because again, we're going to see the equity market still yielding something like 6%, the broad index when you include franking. Interest rates now 1.75%. That's a big differential. And indeed, if you're in a high yield and you're getting 8% type stuff versus 2%, I mean, there's a fair amount of return in equities that even if the equity market prices go nowhere, the income levels of Australian equities almost justify investing in equities just for the income rather than capital gain, which is, I suppose, been the story for a long time. But it's just the story's continuing, and market expectations are again that interest rates aren't going anywhere for 3, 4, 5 years.
Okay. And so the other big development obviously is the budget, which was quite a surprise. Not a surprise in terms of there was a lot of talk about changes to company tax rates, changes to superannuation, changing the tax structure in particular. Obviously, one of the positives is the exempt pension assets or the tax-free earnings in pension phases to be preserved at least to a limit.
Yep.
I know you guys have been doing a lot of work around looking at the zero tax implications in particular in terms of your Australian share strategy. What's your reading on what that change is likely to mean, if anything, and how important is the change in company tax rate to what Plato does?
Yeah, well, I suppose on the first point about for zero tax investors, it's good to see at least you can have 1.6 million each. And the numbers suggest about 95% of Australians are not going to save $1.6 million per person in a couple. It's only about 4 or 5% that actually save more than that. So the vast bulk of people aren't going to be affected. The vast bulk of clients shouldn't be too concerned. We'd all aspire to be able to save more than 1.6 million, but unfortunately most of us can't. And even for those that are above that cap, I mean, my understanding of the rules, and I think we still need to know about this, and we're still subject to an election, is the rest of your money can still stay in super if you've got more than that, and it's going to be taxed 15%, which is still a lot lower than if it's taxed at, for those who are very wealthy people at their marginal rate. So it's still pretty good. And there's still going to be 1.6 million per person in that, which can get you a fairly good retirement. Everybody wants more, but that's still reasonable. At the moment, Australian investors benefit from the franking system. So effectively, in fact, Australian investors don't really pay company tax because any company tax paid is really refundable at the individual client level. So if an investor receives a $1 fully franked dividend, whether it be from a bank or Telstra or whoever, company tax is paid at 30 cents. You actually get a 43-cent tax credit back on a $1 fully franked dividend that's paid out of Australian company tax. If the tax rate's lowered over 10 years to 25%, the way those numbers work out is if we still have a franking system, which they haven't talked about touching, a $1 fully franked dividend would still give you a 33-cent tax credit. It's still a pretty good earner for those sorts of people. Not as good as 43 cents, but it's still 33 cents extra relative to rental income, interest income, and those sort of things. So it's going to reduce the value of franking for people, but it's still going to be very valuable.
I guess the interesting thing about that is, and I know you've written about this recently, is that the difference is, in fact, probably not making a major difference to Australian investors because in reality, as you say, by getting entitlement to whatever tax has been paid at whatever rate, the Australian investors getting that total return regardless. And so it's more, I guess, how much of the dividend payout ratio changes over time will have a bigger effect of that.
That's dead right, because effectively, if you're a pension investor or even at any Australian investor, you currently get back those franking credits in full. So if the company tax rates falls, you just get less franking credits, but you're still going to be, when you add the cash dividend plus the franking credits, you're going to basically be in the same position. It's the foreign investors that get the big benefit, which I think has been undersold a little bit. So that they're the actual ones that are probably going to get more out of the lower Australian tax rate. But then again, that's one of the incentives, is to try and get more foreign investment into Australia rather than it being going to Thailand or Taiwan or wherever it might be, but bring more people to invest in Australia. And not just in resources, but in other things too.
And so, obviously, the maintaining of the franking credits is important for the strategy that you run at Plato. How important is the franking credit versus the dividend run-up sort of scenario? I know you've been looking at that impact in overseas markets. Is the franking credit critical to your strategy, or have you found that in fact it's the dividend run-up is more significant?
Well, if you look at a value add, actually the run-up's probably is where there's greater value add than the actual franking credit itself. We like to think the franking credit's the icing on the cake. It's great for pensioners; they get a full refund, but only about 1% or slightly less than that of our value add comes from franking credits. So probably about 2/3 comes from the run-up. But the interesting thing, I mean, we have been looking, because there has been discussions about franking systems potentially changing in Australia. So we actually have done quite a bit of research, and what we found is that even if they got rid of the franking system, it appears that in every one of the developed markets around the world, the dividend run-up phenomenon still occurs. So it's not reliant on a franking system. It seems to have nothing to do with franking credits. It just seems to be a situation that dividend-paying stocks tend to outperform in the couple of months before they go ex-dividend.
So, Don, recently you guys have launched an international style version of your strategy. Obviously, the Australian-based strategy, part of the benefit of running that strategy is the franking credits that come through, which obviously it doesn't apply to international. And I know you guys have been looking at this in international markets for quite some time. What did you find in international markets, and what made you think that an international version of this strategy could be successful?
Yeah. Well, clearly in Australia we have this unique system that franking credits are an added bonus of the way that we get more income. The reality in Australia, though, is we have a limited number of stocks, and the Australian market's relatively concentrated. And to deliver a high yield portfolio in Australia, you basically have to have fairly large holdings in the banks, Telstra, and those stocks. In fact, we found just a simple measure of the concentration in the Australian marketplace is that last year, 2015, the top of the 6 biggest stocks in Australia actually accounted for more than half the entire dividends that were paid on the ASX 200. To me, that's a little bit of a warning sign in that we are an incredibly concentrated market. You know, half the income comes from 6 stocks, and 4 of those are in the same sector. When you look globally, whilst there is no franking system, so it's a bit of a negative, there are thousands of stocks to choose from. They're in different countries. And there is no, and it's not concentrated at all. The top 6 stocks in the MSCI world deliver around 5% of the income of that index. None of them are banks, and there are some interesting names which give great diversification for Australian clients, such as General Electric and Apple and Microsoft. And even though they pay relatively low levels of dividends, they still pay dividends, and given their size, they're in the top 6 in the world. So having no franking is a negative, but the fact is there are far more dividend-paying stocks, and we can be far more choosy about the stocks that we pick. And what we have found is, just as we see in Australia, the dividend-paying stocks do tend to run up or outperform in that few months before they go ex-dividend.
And so that run-up in the ex-dividend date, or prior to the ex-dividend date, is a major driver of return. It's substantial enough to.
Yeah, it is. I mean, it's not all about the run-up, and it's the same in Australia. It's not all about, it's not we buy every stock that goes dividend. It's about picking the best stocks that run up. On average, stocks run up, but the better stocks run up even more. So part of it is just buying dividend-paying stocks in that area, but really it's about buy the best sustainable dividend-paying stocks. And that's the situation that globally we are not forced to hold 4 big banks. If we said run the Australian process and you invest in Australia, but you can't invest in any of the big 4 banks, we would very seriously struggle to deliver a much higher yield than the market, because they represent such a large portion of the dividend income of that market.
And not such a high yield as part of that as well. So.
Yeah, that's right. They are the high yield stocks, and they're a large part of the market. So if you'd be investing with one hand tied behind your back domestically if you couldn't invest in those banks. Now, globally, it's not the same situation. No stocks, the banks don't tend to be anywhere near as large a part of the market. They're not as high a yield as well. There's much better diversification by industry. We find some good dividend payers in all sorts of sectors, whether it be healthcare, and even some of the IT stocks pay dividends, etc. So you've got a much better spread of income. It's much more diversified across time as well. It's not like there's only a couple of periods in Australia when dividends are paid. You've got, in some months, a couple of thousand stocks going ex-dividend globally. And in the worst month globally, we're still finding 300 or 400 stocks that pay dividends. The worst month in Australia, there's only about one. That's just a situation of having a much bigger pool to play in.
And so obviously then that dividend run-up is an important part of the strategy, but it sounds to me like the underlying bottom-up or stock picking is still the fundamental driver of how performance is generated.
Yeah, I mean, you can't get away from the fact that you want to buy good quality stocks because they're going to have sustainable dividends, but you don't want to pay too much for those stocks. So whether it be the global process, the Australian process, we still very much focus on buying good value stocks and high-quality stocks. And the fact is, we'd say we've got a much bigger pool to pick from when we start looking globally in those sorts of things, albeit we don't have the tax credits that we have in Australia. And that's one reason why the yield we're targeting out of the global portfolios are around 6%. It's pretty equivalent to the cash yield we're getting off the Australian portfolio, but we just don't have those 2 to 3% franking credits that we get in Australia as well. But in terms of total yield, we're getting, our target's about 4% higher than the MSCI World, which is currently only around 2%. But we think if you can get 6% income from global, that goes a long way to helping retirees satisfy their income needs.
And so the global fund will still be a relatively high turnover portfolio?
Yes, it's a fund that's focused for retirees in that, now that $1.6 million of a bucket, because naturally, if you're buying stocks that are going for a couple of months to hold their dividend, that's when that strong run up is. Once that's period, and it's a strong sell discipline across both the Australian and the global portfolio, is once you've received that dividend, you've got that outperformance, you then look around for other stocks which are paying dividends at a later time period. And that's where, again, we also benefit globally because there are many more stocks all throughout the year. Whereas in Australia, we really have two distinct, we have an interim and a final. And so you've got two big dividend periods, and then for a number of months, you've got no dividends almost whatsoever.
So would that, in fact, mean that the global fund could, in fact, be even higher turnover potentially as you sort of move into different dividend periods?
It is actually. I mean, we expect higher turnover out of that fund, and so there could be, as there is in the Australian fund, there could be the potential for realised capital gains and even short-term capital gains, which is why we recommend it more for people in that charities and pension phase assets, which don't pay capital gains tax. But they don't pay any other tax as well. But they can tolerate a higher turnover strategy, whereas typical high tax investors, we wouldn't be recommending this sort of strategy.
All right. So thanks very much, Don, for coming in. Informative as always, and really appreciate your insights, particularly in terms of what's been a very interesting reporting season that in many respects failed to deliver anything based on the hype leading up to it. So. Appreciate you coming in.
Yep. No. Well, at least it failed to deliver the negatives as well.
Absolutely.